Vermont House Committee on Commerce and Economic Development. It's Tuesday, March 14th at, looks like 4:44 in the afternoon. We're here to continue our discussion.
I was like, oh wait.
You're scaring me. Clocks are
To have a discussion on the mental health, substance abuse. I think Julie Tesler is here representing mental health. They have a request to expand the loans to also include substance abuse. And so we're not talking about all employees, right?
I would like to talk about all of our employees, if that's all right.
Every clerical, everybody, is that what you're talking about, or you talk? Go
Can we
ahead.
get there?
Yeah.
Okay.
I haven't met with this committee before, so my name is Julie Tesler. I work at Vermont Care Partners, and I'm joined today by Kelty Stavsep, Executive Director of Northeast Kingdom Human Services, and Stacy Remillard from Northwest Counseling Support Services. So they're here by Zoom. And so I just want to give you a little bit of an introduction about Vermont Care Partners and the agencies that I'm speaking about, and tell you about our staff and our work and this program and the outcomes and what we've achieved with it. And for some reason, okay. So first, Vermont Care Partners, it's a trade association of 16 designated specialized service agencies. They provide developmental, mental health, and substance use services. The focus is that it's very person-centered, family-centered. We do what people need us to do in communities. We are not office-based, we are community-based. We're in homes and schools, workplaces. We're out there with law enforcement. We're in hospital emergency departments. We're in your community. So that kind of sets us apart from other mental health providers. And we think our services are kind of a backbone and a foundation to the healthcare system in many ways. Hopefully, you know your agency, but if you don't, I can point that out to you later. So this is just a map that gives you where the agencies are around the state. So what we do is we have got some mandated things in statute. We provide services to adults with serious mental illness. Sometimes you'll hear that called CRT program. We are mandated to provide services to children and youth with severe emotional disturbance. We also provide a lot of services to Vermonters with intellectual and developmental disabilities. So we're often referred to as mental health centers and mental health services, but a lot of the people we serve, the focus of their services is their intellectual or developmental disability. And we're also preferred providers for substance use treatment. Our outpatient services are a safety net for Vermonters. We often carry wait lists, but we don't refuse anyone. We'll serve any insurance, and we'll serve you without insurance. We'll try to set up a sliding scale fee, but we meet people's needs, and that's our commitment. And a very critical thing we do is provide 24/7 emergency services. To the extent possible, those are mobile services, or again, out in the community. And that's a very critical part of what we do. So overall, last year, we served 30,000 Vermonters. If I had been here a few years ago, I would have said 36,000 Vermonters. This is the result of the pandemic and the workforce crisis. We've not been able to meet the number of needs at the same time as the mental health and substance use needs have actually gone up significantly. Our capacity to meet those needs has gone down. So system-wide, it is a very large system of care. So it's about a $600 million system of care, almost all publicly funded. Some health providers deal with the low Medicaid rates by increasing the charges to private insurance. Well, we don't really have private insurance. So we're totally dependent pretty much on Medicaid. We do some fundraising, we get a little insurance, we have some self-pay and donations, but it doesn't add up to much. So we should have over 6,000 employees. In fact, we've got 1,000 positions that are empty. And unlike school systems, the state employees, healthcare, there is no mechanism for us to get annual increases, and that's really been problematic. There's no cost of living increases on an annual basis. And this year is a typical year. The governor's budget has a request for no increase, level funding for us in a year where inflation is rising significantly. So we're in a very challenged position. And some folks will say, well, you got 8% last year, which we greatly appreciate, but this is the funding gap. As I mentioned, we're not getting annual increases. And so there's this big gap. So the 8% kind of kept us even. So we were in a crisis last year, workforce crisis with increasing demand. We're in the same place this year. It's not much different. We've got a little bit of improvement on our vacancies, but it's significantly below what the market is. So at one position, our bachelor's level case managers in that program for people with severe and persistent mental illness, what we're paying is over 13% below the market. And we have people leave our agencies for pay raises of $20,000, $30,000. And it's not just our clinicians. Our direct support professionals are making often under $20 an hour. And you can get a job at the pizza place, Dunkin' Donuts, restaurants for much more than that. And our jobs are hard. It's hard. It's draining. It's difficult. So we're lucky we have the staff we have, but we're in a very difficult position. So system-wide, over a third of our staff left last year. At the same time, our vacancy rates currently, and they're a little improved from last year, is 16% in mental health, 20% in developmental disability services. So when 1 out of 5 employees is missing, we can't meet the needs fully. We really aren't. We're doing our best to maintain health and safety in the best quality we can, but we can't do it all without staff. And the bar graph on the far side, the largest one, that's the developmental disability services staff. Those are the staff that were not eligible for the employee assistance program, the tuition assistance and loan repayment, because originally the funds came from the tobacco settlement dollars. That's not the source anymore. So this is where, when I said all staff, this is why we need it for all staff, because we're in the worst shape in developmental disability services. So here's the increase in our vacancies. I remember when we got to 760, I contacted the chairs of appropriations and the policy committees, that total panic that it was unbelievable that we got to that point, and it just got worse from there. And you can see it's not getting any better. The chart on your right shows our crisis bed programs. But the hardest staff positions to fill are the residential and crisis beds. And you can imagine nights, weekends, evenings, overnights. It's hard to recruit staff to do that work. When we can't do that work, we can't meet people in crisis. And where do they end up? In the hospital emergency departments, inpatient care, law enforcement, criminal justice system. And it's because we just don't have the staff to meet the needs. So we are a safety net. And when we can't do our job, it's going to affect the hospitals. It's going to affect schools. We're not able to fulfill our school contracts, and we have great expertise and we have great outcomes in schools. We can't meet those needs without staff. We go out with law enforcement. We can't do all that going out with law enforcement as we used to. So really, this system of care is in crisis. The health and safety of very vulnerable Vermonters are at risk. We don't serve the worried well or people who can go to a private clinician or their FQHC. We're serving people whose needs are much more complex. They're dealing with homelessness, with poverty, with multiple crises all at once, including the people with developmental disabilities. Many of those people are having huge challenges. So the tuition assistance and loan repayment program was really a gift. It was very helpful. We did originally get the tobacco settlement funds. It took a very long time for those funds to get out to us, like over 3 years. So we didn't actually get it off the ground really until last winter. Last year, you put in Act 183, 1.25 million for the mental health and substance use staff. Agency of Human Services Originally, the funds came to Vermont Care Partners, and we've been working with the agencies with no administrative costs to get that money out and to coordinate the program. But they read Act 183, even though it was the same language as the tobacco settlement funds, as requiring them to directly grant with the agencies. And those grants haven't gone out yet. So we don't have that second 1.25 million. Our request is for 6 million. If you saw the number of staff we have and would like to have, the money just doesn't go that far. So our request is that we, for 6 million in one-time funds to go to all of our staff, developmental disability staff. We also provide services to people with traumatic brain injury. Stacy's program has a parent-child center. We have Big Brothers and Big Sisters. We've got a lot of programming and a lot of staff. So far in the last year, we have done 320 awards. It's achieved a 94% employee retention rate. So remember, a third of them left last year, and system-wide, we got only 6% of them left. It's supporting recruitment. It's a recruitment tool. Like, we can't offer you a salary, but we can help with tuition, or we can help you pay back your loans. So it's something. And this tuition assistance is also supporting workforce development. We don't have enough workers out there. So to be able to have people have a career track and develop their careers at our agencies is very valuable. So we're going to give you a couple examples. The Clara Martin Center, they've achieved 100% staff retention with this program. 81% of their funds have gone to loan repayment and 19% for tuition assistance. And the tuition assistance has supported nurse practitioner, master's level therapist, school-based behavioral specialists. That it's quite a specialty. The loan repayment's gone for the school-based case managers, master's clinicians, the applied behavioral therapists, substance use disorders, our case managers, special educators, drug treatment court case manager, and school clinicians. The turnover was reduced by 17% in just 6 months. So that was a big deal.
Is Clara Martin a therapeutic school?
Clara Martin Center is the designated agency in Orange County that does mental health and substance use services.
Thank you.
And I do think they have a therapeutic school whose name I don't remember. And if I could get this to move forward. Okay. Stacy, do you want to speak about Northwest Counseling Support Services? I think you're there. No? Maybe Stacy.
Yeah, I'm here. The slide just advanced, but I'm still happy to do that. That's totally fine. Hi, everybody. Thank you for taking the time with me today, and I'm happy to be here. I'll just talk about the outcomes really about this program. And specifically for us, we had a 98.2% retention of staff who took part in that first year of the program, and 10% of them have already reapplied for the next level of funds, the year 2 funds. Similar to Clara Martin, 87% of ours was for the loan repayment, where the other 13% went towards tuition. We found that folks really have a lot of outstanding debt and preferred that method, which was, a cash payment. The program for us supported the master level, bachelor level people at about a 50-50 split. So it didn't favor one or the other. And 95% of it was used for that mental health. We're not the designated agency for substance use, though we do have providers co-occurring situations. But overall, mental health, and the other 5% was for nursing staff.
And Stacy was really one of our leaders setting up this program. I want to give her credit for that. We couldn't have done it without her expertise. Kelsey, would you like to speak about Northeast Kingdom?
Sure. And so I can, first of all, thanks for having me. My name is Kelsey Sesseth. I'm from Northeast Kingdom Human Services. And I actually have a slide that I can send over as well. I just didn't get it in time for Julie. So we had a 91% retention rate of staff who applied to the program and had similar metrics and outcomes as others. I just want to note a few other things. I just have a couple stories to kind of emphasize the data and what it means to folks. But another thing that we've touched on is other entities like FQHCs, hospitals, and some of the other organizations in our area provide similar incentives. And so this is really helpful to not only a recruitment tool, so we put that out here, not only for our positions, but just saying, if you do come, we have tuition reimbursement and loan repayment. This was used again by our children's, adult, psychiatric nurse practitioners, emergency services programs. And so a couple things. So Maggie is currently a clinician actually in our children's. And so she was an intern through her master's program. So we allowed her to, or this program allowed her to pay down some of her debt, helped her get her master's degrees, which made her both eligible for licensure. And once she completed her master's degree, received a raise. And then it also helped build capacity internally for positions that we need, but was a draw for her. Similar to that, Blake took a program manager position, and she was partway through her master's program. So this tuition assistance allowed her to complete her master's program, and she is eligible for getting licensure. And so it pairs nicely with another benefit that designated agencies provide, which is we license a lot of folks in our communities. And so that's for not only NKHS, but across the state. And so we're proud of that. And we also know that we've trained many folks who leave our agencies as well. But the tuition reimbursement and loan repayment has helped people who are interested in promotions and transitioning to other jobs and filling needed vacancies in the clinical areas. And so we've really benefited from that. So I just want to share those two quick stories from Maggie and Blake's. And then one thing I do want to emphasize is that, as Julie noted, we really want to expand this to intellectual and developmental disability services, which we're recruiting for. So that's home and community based. That's also residential. And we've seen over the last few years, I'll speak for Northeast Kingdom Human Services, but in increase in intensity for some folks, especially residential. And so we've had requests through Act 248 with folks who are justice involved but not competent. So we're taking them in. Specialty care procedures, so nursing. And so we're trying to make our pay as competitive as possible, but getting folks in through intellectual and developmental disability services, this is another incentive. We look for people who have 4-year degrees and can rack up debt for not that much pay. So having this as an extra incentive for retention and recruitment would be incredibly helpful. So in addition to asking for the $6 million, we're also asking for expanded use, which would be incredibly helpful to our agency, and I'm sure others. So thanks.
So just to summarize, only there's 44% of our staff are currently not eligible for the program. So when Stacy is promoting this or Kelsey is promoting in the agency, not everyone's eligible. So that's not really good for staff morale, and it doesn't, improve trust with administration. Like, I still have agency directors who do just developmental disabilities. They're still really angry at me that this isn't going to them. And the staff, it's more personal. Like, why not me? I am doing really hard work and I need support. And their pay is particularly low in developmental disability services. The awards that we started with $3,000 awards because we have so many staff. When you have 5,000 staff and you have this much money, you want to spread it and not make it so that people can't access it. But then you can go other places and get much larger awards. So if you go to an F2HC and you make a 2-year commitment, you can get $50,000 in loan repayment. And, we're offering $3,000 to $5,000. So you can see, it helps, but when other employers are offering more, it's problematic. But we didn't want to make it so limited that only a few employees could access it with the resources we had. So expanding the amount would really be helpful. We are a large system here. We're serving a lot of Vermonters with very high needs. We are a training ground for clinicians, as was mentioned. So if you get a master's degree, you then have to do 2 years of supervision to be licensed, at which point many employees leave. But if we could offer them loan repayment and we offer them support with tuition assistance with a commitment to stay, that would really help with that turnover. And, think about the people we're serving. Just to give a couple examples, I go to a clinician. I've had a really rough life. I've dealt with incest. I've dealt with domestic violence. I've dealt with really difficult things. And I share my story really hard. And then they leave. And then I have to tell someone else. And I didn't, you don't get for it. It takes a while to work through stuff like that. So another example, I have autism. I need a keyboard to communicate. It takes 3 months to train someone to work with me so I can communicate. After 6 months, the person leaves. It takes 2 more months to find someone to come, and then the process starts again. And in the interim, I've got lots of emotions and issues, and I can't express them. And sometimes that comes out as violence and other things that are it's difficult for the person. It's also difficult for the other people supporting them. So having continuity, having stable staffing is really critical to the health and safety of the people we serve in our communities. And we want to provide quality care, and we're seeking your support to strengthen our ability to do that. We're looking for a rate increase, but this is also kind of a complement to that can strengthen our workforce and meet the needs of our communities.
Julie, I feel like we have a little bit of a disconnect because I received information through the healthcare committee about changes we needed to make in language that we had in Act 183 to 29E to include mental health professionals and substance abuse. That's not the right word.
Substance use.
Okay, well, so and so that language is in S11, and so I don't know what the change. I guess because what the change is. What is the change you want? Do you want just
employees of designated and specialized service agencies, so that we're not saying only you, this 56% can access these funds, and the other 44%, sorry, we value you, but we're not going to give you tuition.
Okay, so you want that language removed. You want that language removed. Okay, and then only for advanced degrees or all staff, because it's for people with advanced degrees.
Might I jump in?
Sure.
This is Stacy. Sorry, I thought I would just maybe jump in. I think what we're trying to do is just open this up to all of our staff, because I heard right from the get-go, I'm not sure who said it, but somebody said, are we talking clerical staff as well? So I want to emphasize that our organizations have operational staff. You're talking about IT, finance, HR, facilities, reception, all the same challenges that other businesses have that are outside of our industry. And so we're talking about those staff. We're talking about the developmental services staff that Julie talked about. We're talking about adding language that is inclusive of everybody that works for our industry, because every job is important to making sure that the services are provided, just as Julie mentioned. I think that's the language, if I'm not mistaken.
But the language we're looking at is for a forgivable loan program.
Correct. So I would say that it is not for everyone, as when you think about all, it is still to do with loan forgiveness or tuition as the program is structured. It's the folks that are working on bachelor degrees, master's degrees, or have those degrees and now are weighted with the expense. So I think that's still the same. That's not changed.
Okay, so there's a couple of problems. Like the information that I received was for a $1.5 million program, not a $6 million program. And then it was unclear to me that you wanted to have the language stricken, that you wanted to have the where specified in S11 for substance use disorder and mental health services professionals, you want that taken out. So I think we need some better.
I'll follow up with you.
Yeah, we really should work with Lori.
Okay.
So have you talked to Human Services about this?
We did not have an opportunity to provide budget testimony to Human Services, but we did get a chance to provide testimony at House Healthcare.
So this sounds like a human services issue that they should be weighing in on. And we're providing a vehicle for these things to happen. And so we need recommendations, or we need the language and the changes to go through the appropriate committees, that they would then bring it to us.
Okay.
And so we've got like 3 days to do this. And so I would touch base with Chair Wood.
I will.
I think, you know, your presentation, I mean, that committee has to be on board with those recommendations and recommending making changes to the statute and the language, as well as healthcare. And, you know, we'll make sure that somebody from our committee is following this piece, probably Logan, Representative Nicole, so that if that's what they recommend, and the committees are comfortable, then we'll put it in the bill. And then if it survives going through the appropriations committee as well, then we're good to go. But I think really need to advocate to those committees. And then we'll work with them and agree if whatever they come up with. That's how we did it last year. We worked with those two committees, you know, we did all of these programs and this one as well. Was it? They recommended we put it in the bill. We're not the experts in any of this. We certainly hear the issues that you have and the difficulties, and it's not unlike a whole lot of other businesses as well. But we want you to go through committees that know the subject matter better than we do.
And just so in our current draft, I believe you're talking about section 25, which is the Vermont Mental Health Professional Forgivable Loan Incentive Program.
No,
It's not.
no, I think 29E was the correct.
90 is from 1 Act 83.
Yeah.
So that's last year. So I'm
There
just
is
saying,
nothing in the current draft that I know of.
oh, okay. Then it's definitely not in here. Okay. So,
I looked.
okay, then it's something completely different that we're talking around. Okay.
That's why it's good to go through the other channels so that, yeah, if you can work with them and they come up with something they want us to do, then we'll do it.
Okay,
So
I will follow up.
I'm sorry, I think page 17 is the section 25. That's the one that you're talking about? That's the Vermont Mental Health Forgivable
Yes.
Loan?
Yes.
Okay, so just so I'm clear, we're talking about that 1.75. We're not talking about future. It's clarifying language on the 1.5.
That was the information that I received was about that, and I think that the language in Act 183, my understanding from Lori Houghton was that that was the language you want to change in Act 183 29E, so it would fit, it would work within this new bill, section 25. I think it might be confusing.
Okay, thank you.
Yeah, that's where I'm confused, because I thought we were looking at section 25 of this bill for $1.5 million to help the mental health professionals and the loan forgiveness. But the program you're describing is different.
Yes.
Okay.
But I will circle back to Representative Houghton and Representative Wood.
Okay, good,
Okay.
that would be really
Thank you.
helpful.
Thank you for your
Good.
time today.
Thank you.
Julie.
Opportunity.
Thanks, Stacy.
I appreciate your time. Thank you.
Kelsey.
Thank you.
Thanks, everybody. Appreciate your time.
Thank you. Okay, so now we'll switch gears and go on to H87 and see what we can accomplish there. So a couple other pieces. There's a study in there. There you can see.
Okay.
So David, if you'd like to join us.
You guys don't want a break before earned wage access services? Come on.
I think we have people that want to hit the road to go home.
All right. Well, that makes my job easy, doesn't it?
Too bad.
Okay. Well, afternoon. Good to see you again. Been a long day since I've seen you all. Hope you had a good one.
Interesting.
I'm sure. This is the fun committee after all. I think we're looking at H87. Yes.
Yes.
You should have on your page a draft 4.1 of a committee amendment. Everybody have that?
Yes.
And Andrew, you posted the one I sent you that was edited. Great. Thank you so much for your quick turnaround on that. So this document that you have on your webpage has highlighting in it, and I'm going to pull it up on the screen. I assume that's what you want me to do. So there's been a lot of work outside the room, good work by DFR and industry folks. And so in the document, the highlighting reflects changes against the last time we looked at the draft together. There have been iterations of changes in the intervening steps among that group of folks working together, but this is what I think is the most current, it's the most current language. I'm not going to characterize the proposal as being unified or any particular groups, but here's what you have. The yellow is language that came to me reflecting the changes that are the most current from the outside the room work. And then you'll see some blue in here as well. And the blue is my work intended to be non-substantive, stylistic or organizational change that I genuinely hope did not change any of the substantive work that others have done. DFR has had a chance to look at that and made some more helpful suggestions. I don't know the extent to which other people have seen that, so understand what we're all looking at together is sort of an amalgamation of that group work plus whatever I did last night. In the interest of time, I'm going to try to go highlight to highlight, and you're going to have to ask other people deep questions about why if you don't understand all the changes, but I'm going to try to give you an overview of the what. So remember, we're talking about earned wage access services. You know, you sign up, you get your money a little early. One significant and I think positive change here is the addition of terms that are defined terms for sort of the employee direct model versus the employer provided model. So the first one, direct to consumer provider, means a provider that offers or provides earned wage access services directly to consumers based on the consumer's representations and the provider's reasonable determination of the consumer's earned but unpaid income. So that's the one model. That's you sign up for the site and they provide it directly to you as the individual. You know, a lot of these changes are minor. The addition of salary, it's paid to or on behalf of an employee. The next addition, though, here is the other side of that, the employer integrated provider, which is the provider that offers or provides earned wage access services to a consumer using time and attendance or earnings data for the relevant pay period. It's provided directly or indirectly by an obligor or a service provider of the obligor. So this becomes important, of course, because later on when we have what kind of services are we talking about, we've got the basic services and then we've got the additional or employer services, and they're treated a little bit differently. So it's good to know we have those two defined terms in there. We still require a license for a person involved in this business. The application, one new piece here is that it needs to include a statement or indication whether the provider is an employer integrated provider or a direct-to-consumer provider or both. So when you're coming to DFR, you're going to identify yourself as one or both of the models. On page 4 here, the licensee requirements, terms of service. So this was rewritten here in A on basic services. I think it's an improvement. So a licensee shall make available to each consumer to whom it offers earned wage access services a basic level of service that provides a reasonable option to receive proceeds at no cost to the consumer, consistent with any minimum requirements and standards the commissioner adopts by rule or order. Pretty straightforward. Any questions on that? So for employer services, additional services, so this applies now to an employer integrated provider. They may impose a charge or fee on an obligor who contracts with a provider to offer basic services. So they're going to sign up with somebody else to do this for you, in which case they can charge the employer for the offering of the basic services or to provide additional services to consumers who are employees or contractors of the obligor. And 2 here, a licensee may offer additional services that may be subject to the following charges or fees. So you could charge a charge or fee for the optional expedited delivery of proceeds, a subscription or membership fee for a bona fide group of services that includes earned wage access services, or other charges or fees that the commissioner allows by rule or order. So that would be give some flexibility to the department there on the regulatory side. C, it's highlighted blue just because I broke it out now into its own subsection. So this deals directly with optional gratuities. I got rid of the word tip. I felt like tip and gratuity are redundant for purposes of federal labor law. Gratuity includes a tip. So rather than saying both of those things, we'll just call it a gratuity and say that they may solicit an optional gratuity before finalizing the payment of proceeds, provided that the licensee provides clear notice that it is optional. If the default setting for the amount of the gratuity is not $0, the licensee provides the consumer a clear and accessible option to change the amount and leave no gratuity. And to approve a gratuity, the consumer must either affirmatively consent to contributing the gratuity after entering a dollar amount or percentage value, or confirm a prominently disclosed default amount. So that's obviously a change from what you had before, which was a de facto set the tip at 0. This is a little bit different construct. I think it hopefully is self-evident, but if you have questions, now's the time.
I have problems with this part. But is there, and it's free speech, you've educated me a little bit on this, but the thing that I'm wondering is, can we set a maximum amount of a percentage? Or can we do something like that so that, okay, if it's not set at 0, but it cannot be set over 3% or 2% or something reasonable?
I mean, I think that's a possibility from a regulatory perspective. The speech concern that I had was if you say you can't mention this, you can't verbalize, you can't solicit a gratuity at all. Right. You're not allowed to say that. So we've assuaged that here. How you change that the regulation now that we're going to approach it is a policy choice.
But we also haven't said that if it doesn't default to, we haven't made it default to 0.
Right.
So can we put something in? Would people agree to say that it can only be a certain percentage of the total amount that the person's getting? Because I think it was $14 for $100 or something. That's 14% for 3 days, or that's
Usury.
Thank you. That's the word I'm looking for. It's usury. And we do so much to protect Vermonters and their wages and give them opportunities to increase their education and all of this. And I just think we should protect them from this.
Do I have a just clarifying question? Is it the free speech issue is that we can't say that it should default to 0, or that it that we shouldn't, like, is that a free speech?
The only free speech concern that I had was when the committee was considering saying you can't ask for a tip
Okay,
at
so we
all.
could ask for it to be that it defaults to 0.
I think so. Like I said, I mean, we, as DFR testified and is the case in consumer protection law across the board, we have usury laws. We set the maximum amount of interest people can charge. We do all kinds of regulatory activity. It's the chilling, it's the
No, yeah, I.
complete disallowance of
Yeah.
solicitation that was giving me pause.
Okay.
So within the framework of maybe there can be tips, but how are we going to regulate consumer protection with respect to how tips are solicited, what the amount is, what the format is? That's probably all just within the normal range of regulatory activity.
Edie?
Yes, something that I'm gonna be looking for throughout this bill, and especially here, is how we're conveying to the consumer what they're doing. So if there's a dollar amount for the tip, but no percentage, so that the consumer doesn't understand that this is a 30% tip, or that's a problem for me. I feel like the more information we give people, the better they're gonna be able to make decisions. And so throughout, like, this has kind of been keeping me up at night since we started working on this bill. And I feel like,
Me too.
for me, that's the best way to make sure. And so how do we ensure that? How do we ensure that, every cost associated with everything in this system is very clear to the consumer how much they're paying?
Jared?
I'm still viewing it from the perspective like the restaurant industry. I mean, if you leave a 15% tip for a $10 bill or 15% tip for a $100 bill, it's still 15%. And at this point in time, and especially with the definition of usury, they're not charging an interest rate. This is a voluntary service, and part of their profit model is derived from tips. So they're not charging for that additional service. So that's where I kind of have my concerns on, because at that point in time, when we're throwing a number out there, okay, we're going to regulate 3%, when in other markets where people may tip 5% on a $300 loan that they have, then at that point in time, you're directly affecting that business's profit margin. And if it's based off of voluntary service, they're not forcing consumers to do it. We want consumers to be informed, which I recognize, but I don't think we should say, okay, well, you're only allowed to tip up this amount of money on a voluntary transaction.
David, I'm not sure if it's in this section, but I think we certainly, or at least I think I brought it up when we last looked at this bill, which feels like a year ago. But anyway, it's about building off of Edie's point on consumer transparency and any requirement we could have around monthly reporting. I hope it's not just annual, but monthly reporting, so people can see the totaling of, because this bill impacts working people. People are, with all respect, they're not going for a $300 dinner. They are trying to get an advance on payment to pay for probably their electric bill or something. And so I'm worried about making sure that folks are not unknowingly spending a large amount of money over a period of time because they have to regularly use this service. So we talked about kind of that reporting part, and I just don't know if it's, because tips are part of it. This is really specifically the tip part around, because it's really the only fee. My question is around reporting, and if there's anything in here around requiring some sort of regular, hopefully monthly reporting of these services by the company.
I don't believe that is in the statute. It could be adopted by rule, but it is not currently part of this statute, I don't think.
Okay, I can hold that question after our walk through here, but thanks.
Monique?
I guess a question for you. Is it an appropriate time for a suggested language change on the line, or should that be held to the very end?
Well, I think what we need, we're just hearing from
Okay,
David of
got it.
the words that are on the paper.
Thank you.
I think we need to hear from people of the industry. We also need to hear from DFR of their comfort level, and we need to understand they're the regulator. I think what we need to understand is this is happening now and it's not regulated. And so, keep all of that in mind. David, can you go back to where we were?
Mm-hmm.
So up at capital C, we're talking other charges or fees that the commissioner allows by rule or order. Does that apply to C, small c?
No. So, because the reason being that subdivision 2 here is governing additional services that may be,
This is not an additional.
so that's the gratuity is certainly not an additional service that they're offering for a charge or a fee.
Sorry, technical question. Is this being weaved into a law that's already in existence?
No, this is all new.
Be the first law in this country.
So, right, okay, then I need to understand why the big C goes to a little c and not like a 1 or a 2 or an A or a B.
That's just our drafting conventions. So like on line 11 subsection, so if 2304 is the section, the next level of designation down is called a subsection. And that's the A, basic services, B, employer services. So those are subsections. Within a subsection, everything else is called a subdivision. And it goes down the line. 1 is that indentation on line 12, and then capital A. Then we have the small Romanet I, 2, 3, and then the large Romanet I, 2, 3. And then after that, you start getting double letters and double Roman numerals and
Vision.
I need
Why would it C be an A or a 1?
which one?
The blue highlighted C, that's the only little.
right here.
Because it's the next subsection that broadly applies to terms of service.
Got it, with you. Got it. Thank you.
No problem at all. No problem. It's the right, it's the right question to ask.
We'll hear from DFR, understand from them if they're comfortable with this language, why they're comfortable with this language, how they anticipate that they can make sure that consumers are protected, because they're the regulator. We want to make sure that whatever we do, the regulator is comfortable, because their number one job is protecting Vermont consumers. So I think we can note, I know Ethan has his hand up, but let's get through the bill and then we'll have DFR go through it with us, and any questions we have and why they are comfortable or where they may not be comfortable.
Okay, so that next piece, required disclosures, notice of terms and conditions, is largely unchanged until we get down to subdivision 3. Anytime a licensee offers or provides additional services for which is in charge imposes a charge or fee, licensee shall comply with disclosure requirements and standards that the commissioner adopts by rule or order. Cancellation of service here, a licensee that offers or provides these services on a recurring basis or as part of a subscription service shall allow a consumer to cancel participation in the service at any time without charge. And then under F, I just moved this up because we're talking about positive rights and affirmative duties. So I took this from thou shalt not and put it up in the you may. If authorized by the licensee and consumer in the service contract, a licensee may terminate service to a consumer who does not pay outstanding proceeds or pay a charge or fee permitted by law. So non-recourse obligations and permissible collection. So here we have the three modes still. It's still a payroll deduction possibility. So pursuant to an agreement with the consumer and the obligor, a licensee that is an employer integrated provider may initiate an obligor facilitated payroll deduction, direct payment to the provider by or on behalf of an obligor, or obligor facilitated assignment of the outstanding proceeds from the consumer's next paycheck. A licensee may make not more than 4 total attempts at a payroll deduction, direct payment, or assignment pursuant to subdivision A. So again, this is the payroll deduction possibility if it's consistent with an agreement, basically among consumer, obligor, licensee. It can manifest in one of those 3 ways. You only get 4 attempts total among those 3 modalities, right?
It's more than it was in the original.
Yeah, I was just gonna, it went up. I'm gonna ask that one up to DFR though, but that's.
Okay.
DF.
So the electronic transfer has been reworked. It's not limited. It did say ACH withdrawal, remember? So it's not limited to ACH, but it is an electronic funds transfer. This one is also not more than 4 attempts at a funds transfer from a consumer's depository account at a financial institution. Lots of ifs. If the consumer consents to repayment of outstanding proceed charges or fees through an electronic transfer, if the licensee provides prior notice of the date and the amount of the transfer, if the licensee attempts to transfer only on the date and in the amount specified in the notice, if the licensee complies with all the requirements applicable to the payment system it uses for the transfer, and 5, if the licensee uses reasonable care to avoid causing a consumer to incur a fee or penalty for insufficient funds. Under B here, a licensee who violates any of those shall reimburse the consumer for any fee or penalty the consumer incurs due to that violation. The periodic invoice is not more than 3 attempts at a written invoice to the consumer. So yeah, it's 4 of the payroll, 4 for the electronic transfer, 3 written invoices. You can talk to DFR about that. There can be other means if authorized by rule or order. And you can still try to collect outstanding proceeds, et cetera, if there was fraud on the part of the applicant. All right. So prohibited acts and practices, though this is shorter, it's largely just because I was trying to like pull all of the fraud into one box, all of the penalties and charges into one box. So it's still the same, I hope, still the same scope of things that thou shalt not do. So a licensee shall not impose or attempt to collect a charge, fee, penalty, or interest for, providing basic services for an employer or additional services if those charges are not otherwise authorized above, for the failure to repay outstanding proceeds or a fee or a charge, or to defer the collection of outstanding proceeds beyond the original schedule for collection. A licensee shall not condition the availability or terms of services, including the amount of proceeds and the frequency of payments, on things that we had already had in this bill, whether the consumer chooses additional services, the amount or type of charges they agree to pay, a requirement that you hand over property or create a security interest in your assets, or on your credit report or your credit score. So that can't change the basis or availability of services. 3, now sort of broadly, you shall not commit an unfair or deceptive practice in commerce, act in commerce. That includes false or deceptive statements to any regulator, government, or consumer, solicit delayed repayment to recoup more fees, or any other practice, act, conduct prohibited in the attempt to collect this. That's a violation of the Consumer Protection Act under 2453A. They still cannot report a consumer's payment or failed repayment of proceeds or of fees or charges to a consumer reporting agency or debt collector. They still cannot discriminate against people, still cannot transfer proceeds in a virtual currency without written approval by the commissioner. The rest is largely the same, still saying that if you do this, service in accordance with the laws that are provided here, then therefore it's not a loan, it's not wage assignment. rules commissioner can still adopt rules and orders, issue rulings, demands, make findings, including imposing limits and requirements on the amount, type, and disclosure regarding earned wage, excess services, and charges of fees or services. So, I mean, in a generic sense, your concern about tips would come here, the types of disclosures they need to make, basically the amount, type of fees for the services. So it's a pretty significant amount of regulatory authority vested in DFR here. The private right of action and the Consumer Protection Act. So consumer can still bring a private right of action. This is for damages caused by a violation of the chapter against a provider who was required to be licensed but was not at the time the provider offered or provided these services. So
It's pretty limited.
that's a little bit narrower. That's narrower than what you had before. This is just for unlicensed actors now. I will say that, there's this dance between the Consumer Protection Act and all these other laws that protect consumers. When you make explicit activities that are a direct violation and you peg them to, or say this is a de jure violation of the CPA, that is one mechanism of regulating activity and then providing CPA protections. This is not happening here in the same way. It's not that broad in scope. That does not mean it wouldn't be a violation of the CPA. It's just not saying there is a 1-for-1 here. If you violate this chapter, you are also violating the CPA. So understand that nuance. Applications, all the same. Renewal, all the same. That's the grace period is the same, except that they're adding this last piece here solely for purposes of 8 VSA 2309A. A provider that has complied with subsection B of this section, which is filing the application in time and all that, shall be deemed to be a licensee during the grace period. So this is the safe harbor transition language that functions largely the same as we last saw it. Whew. We get through?
Okay. Any more questions for David as far as the language goes? Okay. Thank you, Dave.
All right.
Thanks. So I think we have Ethan. Is Aaron with you as well? Yes. Okay. Deputy Commissioner Ethan, thank you for joining us. So I think we'd like to get your take on the bill as it's, we just went through it as it's drafted now, and make sure that, number one, you're comfortable, that you feel that there's enough protections, there's enough regulation in there in order for the department to protect Vermont consumers from anything, in the earned wage access realm.
Yes, well, I'm happy to talk from DFR's perspective about some of the changes we made and why we made them. So just in terms of process, after our last meeting, we met with Earnin, PayActive, Daily Pay, and Block, so formerly known as Square. We received one round of comments from several of the companies on the bill. We sort of reviewed all of those. We circulated a draft to David Hall, sort of copying all of the folks that we'd spoken to, and then we received another set of comments from these companies, and then we submitted a revised round of revisions to David Hall. In each case, we only accepted the changes that we thought were prudent to make, and that we thought made sense. and I'd say that the draft that David has presented you with today is one that that DFR is comfortable with. With that said, if and I'm going to walk you through why we did things the way we did based on the input we got, which I think you'll find helpful. But if the committee decides it would rather go a different way on certain of these issues, we're not going to oppose that. There are multiple ways to do this. In the course of meeting with these companies, sort of before this latest round kicked off, we sort of proposed a bunch of language that was going to narrow the way things could be done, and that was very specific. And one of the things that came across to us in the course of these meetings is that there are many ways to potentially get at several of these issues, and there are many ways that providers deliver services. And we were realizing that a number of the changes that we made or proposed were having all sorts of unintended consequences, and prohibiting things that we weren't intending to prohibit, or would cause problems that we didn't intend to cause. So one of the sort of themes of what we did in a couple places here was move some things out to rulemaking, or provide some discretion in the rulemaking process. And part of the reason that we did that is we, through the rulemaking process, we wanted the ability to hear from a wider range of constituents over in not such an accelerated time period, that we were going to put things in the bill that, again, we're going to have these unattended consequences, and that it could be really thought through. So with that said, I'd like to talk about a couple of the specific changes, just to let you know what our rationale was. And as I said, if you'd like to do things differently, that's certainly your prerogative. You are the lawmakers. So the first thing that I guess you notice, we made this distinction between direct to consumer providers and employer integrated providers, and then had an umbrella term that covered both, right? So both under this sort of umbrella of earned wage access services. That's something that we saw that seemed like most a distinction that was made in most bills and regulations that we saw. And there are times when it makes sense to treat those two models differently. We didn't see any harm in making the distinction. On the issue of gratuities, and that's probably the one that as came out during David Hall's testimony, one of the hotbed issues. We did hear from Earnin, and they're the provider that has tips as sort of an important part of their business model. And the argument that they made to us is this is our primary way of making money, and for a lot of the direct to consumer folks, this is a primary way of making money. I think it was something like 96% of their consumers end up reducing the tip or eliminating it altogether. So it didn't seem like there was necessarily an issue where consumers were getting confused. I looked at all of the complaints on the Consumer Financial Protection Bureau regarding Earnin, and there were complaints about overdrafts, about things not happening on the day that they were supposed to. And that was one where we addressed that, specifically. It must be done on that day. And if for any reason it isn't, the provider has to reimburse, any overdraft fees and things like that. What we didn't see was a lot of complaints about tips. And I think that consumers are used to seeing, these tip options, and people see a tip, they they know it's optional and that they can change it. And we tried to reserve the discretion in rulemaking expressly to set limits on the tips. And part of the reason we did that is, California is coming out with a comprehensive set of rules. To the extent that there are, best practices that are developing in the, in the different bills that are being considered around the country, and in the, rules being considered, by California regulators, we thought leaving that to rulemaking gave us some flexibility to sort of conform to what the emerging best practices were. That said, if the committee feels strongly that you want to mandate certain caps in the law, that's certainly your prerogative, certainly something that you can do. Something that we wanted to be sensitive to is that, if your employer, the obligor, so it could be, some sort of person paying you as a independent contractor, if they don't contract with a, with an employer integrated provider, the direct to consumer is your only way to access a product like this. And, it seemed like the committee's intent was that they wanted Vermonters to have access to this product, but in a way that was well regulated. So we didn't want to inadvertently do something where it's going to require doing things totally differently in Vermont, where we're a small enough market where they would just say, you know what, we're not going to offer it there. We'll offer it everywhere else because we have to change everything, and then we wouldn't make enough money to make it worthwhile. We'd have to, change up what we did. So that was our rationale behind it. We hadn't seen a lot of complaints or seen a lot of evidence of consumer harm from the tips. We thought that we had reserved the discretion to put limits on the tips, especially if that was, emerging as a best practice. But there was a lot of concern about having a default tip level of 0, and that if they did that, would that model still be viable? So based on that, we're okay allowing a default tip, as long as it was very clear that consumers had the ability to change it, which again seems to be how these products are generally offering, the ones with the gratuity based model. And as I said, we hadn't seen a lot of evidence that this was a major source of concern with consumers, or that they felt like they were being duped by the tips or consenting to ones that they didn't want to give. I think there was one complaint we saw where someone had, approved a tip that they didn't intend to. But again, we weren't seeing, widespread, didn't have indications. As I said, we've never received a complaint about this product at the department. So we were, the department wasn't going to object to having a default tip, as long as, there are these other protections in place, and we could put a cap on it later if that was, proving to be a best practice. But that said, happy to take any questions from the committee on that issue, or anything you have, or I could go on and talk to you about why we did some of the other changes.
Why don't we start with this and questions? Emma?
Well, just, hi Ethan. So just to follow up on a question I had earlier, because I think it's specifically to gratuities. So this idea about helping consumers have transparency and how this starts to total up, especially with, how much or how little they're using the service, et cetera. So I'm just wondering, I know this is such an emerging thing, but is that something that either A, can also be done by rulemaking later on in the process as we see these other states starting to kind of roll out their practices and what they think is best for the sake of, again, consumer transparency on this case? Or did you discuss that at all around putting it into this particular bill around consumer awareness, like the totaling up of things like gratuities? Even if there's not complaints, I think there's a whole other side of just consumer education that I think is in the interest of consumer protection law.
Well, I will say I did not have this, specific conversation with any of the folks who approached us with comments. With that said, I don't believe that any of them are currently providing that level of reporting to consumers. I think we do have the authority through rulemaking. Well, I know we have the authority as it's currently drafted because we, expressly reserved authority with broad general rulemaking authority, but also expressly sort of reserved authority to make rules about disclosures regarding fees. So I think that's broad enough to cover, disclosure about specific fees, but also to, provide some sort of disclosure about aggregate fees. My sense is if we, had a requirement of, providing some sort of monthly or yearly aggregate information on fees and a separate reporting thing, I think that would probably require most of these platforms to make, some programming changes to their app that's specific to Vermont to make that information available. And as of right now, I think we'd be the only people requiring that. But you have the authority to regulate this space, lawmakers, as you see fit, and that's certainly your prerogative. I said if that was emerging as a best practice, I think it's absolutely something that we would strongly consider requiring, so that people could get that aggregate info. But it's not something that we had spent a lot of time on this draft. I think just because we hadn't seen it being done anywhere else, but I can see where that would be sort of a powerful thing and might be useful to consumers.
Just one small follow-up. You said about fees. Just to be clear, gratuity would be considered under fees in terms of rulemaking, or do we have to be specific about that? Is there a legal
I would consider it a fee, but we could certainly. I'm no opposition to expressly adding the word gratuity in there just to make it crystal clear.
Thanks.
Heather?
Ethan, I heard you say something in the beginning that 87% of people change the tip. Is that what you said?
Don't. I probably gave more of a. That probably seemed like it was more scientific. I recall Ernin or one of their representatives saying that was a very high proportion. I think it was in the neighborhood of somewhere of 85 to 95% of people end up changing the default tip. If it wasn't even higher than that, I believe they're on, and they could give you the specific figure, but it was very high.
Well, and that's changed significantly to what we heard in the testimony. So that's the reason I'm asking about that, because my understanding, 60% of people left tips.
Yes. So there was, I think it was 40% of people changed it to no tip. And then of the remaining amount, a significant percentage of them decreased the amount of the tip from the default. And again, I would defer to the industry folks on the exact amount, but the impression that I got was that it was a very high percentage, substantially high percentage, modified the tip amount in some way, either by eliminating it completely or reducing the amount. I don't think there were many times where people increased the amount.
I think a cap, my feeling is I think some kind of cap is appropriate.
Well, I think what Ethan said was that they reserve that right in rulemaking. I think they need some, I think they need some leeway to understand what else is going on in the industry, and as things, evolve, that it gives them the authority to make those changes as they see they need to be changed, instead of, if we steadfastly put something in, it's there, and they don't have that ability to.
And I see your point, and that gives me some assurance. But if we're the first state doing this and we're setting the best practices, then I think it's kind of up to us if other people agree. I mean, I'm glad that they're going to be regulated, right? Because no regulation in this realm concerns me, because it's close to banking to me. It's close to an ATM machine, getting your money, all of that. So, that part of it really concerns me, when I think they said 80% of their customers are women. One company, I think it was Earned In, said that they give $25 to $100. So I'm imagining that it's a mother, a single mother, who's trying to get $25 to $30 to pay the rent, to pay the electricity, pay for breakfast, pay for a field trip, and then to be slapped with, the default was $14, as I recall, for $100. Plus you paid you pay $1.99 fee. So when you take that into consideration for a 3-day loan or a 5-day loan, if we amortize that, or whatever the actuaries do, I just know that's a lot of money for a very short period of time. That's money that's yours that's already owed you. So I have concerns about the industry. I'm glad we're doing something about it. But if we're doing it, if this law is the first in the country, then I think we can dictate best practices.
We're the first state to put a law in. California, however, is doing it by rule. California is a lot larger state than we are, and if we're not trying to work within the industry so that we're close to being a model as possible, where they don't have to make changes to their to the way they do business, then the other thing is they're doing business now already in all 50 states. They already have a platform that they've set up. We can make whatever changes you like, but if they have to change it, from what I understand, if they have to change their platform, from what I've heard Ethan say, is that probably not going to be lucrative for them to be in Vermont, and they won't offer the product in Vermont. And that can be what we want to do. I don't know. But if we see value in this business for Vermont consumers, and as long as we have a regulation and a regulatory body that has, number one, a good reputation for protecting Vermont consumers, then we should try to allow them to work within the industry and whatever is happening around the other states, in order to keep it going and regulated in Vermont. So I think, those are the choices. Do we want it? Do we want that business in Vermont? I think with payday loans, we made sure that if they were going to operate in Vermont, they were going to be a licensed lender. And to my knowledge, I don't think any of them have applied for a licensed lender, a license in Vermont to provide that. So we eliminated that predatory industry. This is a little different. I think we have to make a decision of, do we want, like I said before, is this valuable to Vermont consumers? If we feel it is, we need to have good regulation, but if we want to regulate it so they can operate in Vermont, then that's what we need to do if we don't want them. So I think that's kind of the decision that we need to make.
I would say one thing that we were thinking of, or at least mindful of. Of course, Vermont's a sovereign state. It can regulate this as it sees fit, by law, by rulemaking. But California has been working on these rules for years at this point. They've had a very lengthy process with a lot of input. We work very closely with the California regulators in a number of other areas, and personally, I have a high opinion of them. They're very smart and thoughtful, and concerned about consumer protection. So I think when they promulgate these final rules, I think those are likely to become the national standards. And I wish that they were promulgating them, a month before we were considering this, and we could, integrate some of those ideas in. But we were mindful of that too, that it would be helpful to be able to see some of those things, because anything that California requires, it's such a huge market. They're all going to get on board. They're all going to accommodate it, and they're going to accommodate it quickly. And we can just bring in those exact same requirements in Vermont, and no one can push back on it and say, we're going to leave Vermont because that's not something that's possible for us to do. They're going to find a way to do it. So, but again, if the committee or lawmakers want to do something different, including putting a specific, express cap on tips, we're not opposed to it. But after, sort of hearing some of the other opinions, we came to the conclusion, DFR, that we would be, comfortable doing that and, considering that issue later as this, regulation of this space, continues to evolve on a national level. But again, this is the decision for all of you to make. And if you want to put a cap on it now, that certainly your prerogative to do, and we wouldn't oppose it.
So I just want to say first, thank you to all of you for putting this bill together, because I think it's much better. It's much more clear. It's much more comprehensive, and it makes a lot more sense to me. So I really appreciate that. I'm curious in the rulemaking, and how much you know about it, if you're seeing requirements for reporting to consumers or to users of the product or not in the rulemaking so far.
Right, in terms of aggregate data on their use and fees that they've paid over time.
Yep, short term, long term, all of that.
I have not personally seen that. I think there's a lot of reporting. There's a lot of reporting back to regulators on this, especially under some of the MOUs that the California regulator has entered into with earned wage access companies that many of them are operating under now. Yep. I suspect that some of what they've received in those reports is going to inform what they require going forward. But I don't know off the top of my head whether anyone has considered or proposed that at this time. Although I wouldn't surprise me either way.
And then can I we don't have any requirements in here, do we, for that kind of reporting to you, or is that through rulemaking?
No, I don't think we have express requirements, though we have, general examination authority to request any information about their business that we deem, material to their operations or to safety and soundness, just in our sort of general statutory authority over licensees. We have pretty broad authority to require information and reports about, things we see fit that relate to, the business they're conducting in the state.
I'm wondering if there's a way to require, if they receive X percentage of funds from consumers, that they have to report that within a certain amount of time, right? Like I'm wondering if we can put things into the law that will dissuade customers from overcharging, or dissuade earned pay companies from overcharging customers. Does that make sense?
Like providing a financial statement at the end of the quarter, the end of a year, the end of the month.
If they
of what
have
they paid.
any customer that's paying 20% or more of the money that they're getting to, in fees, or, whatever kind of fees, tips, all of that, that they have to report that within a certain amount of time. We pick it up, just thinking about it coming at it a different direction.
I think hold that question for when, I think we need to hear from the providers and what that would mean for them. I don't think, I think through, if that's something that California would decide that consumers needed, they could put that in. Is that something that you could follow along with in your rulemaking as well?
Yep, it absolutely is. I think we'd have the authority to make rules about that. As this is drafted right now, we're not required to impose rules about that. But as we're developing those rules, we're going to be looking very closely at what other jurisdictions have done, and what the best practices are, and what the Consumer Financial Protection Bureau is requiring. I said, I think national standards are very much evolving in this space, and I think we drafted our changes in a way that we thought would give us the flexibility to conform to those national standards. And at the same time, if there are specific areas of concern, or things that we are hearing from Vermonters were a problem, or that there were a lot of complaints about in other states, we'd have the ability to address those as well.
Just the last thing that I want to say is, I think about this like people using their credit cards to borrow money, right? And so the numbers there are, I pay off my credit card every month, so I don't know what the interest, like 18%, I think is too high, right? Like, so whatever that number that is too high there, I think is the number that we should be thinking about with this, or something even lower than that. Just kind of needed to get that out of my brain.
I just I went back, because I take notes as much as I can in committee. And in February, I did ask the same question on reporting to Earnin when it was in, earning, whatever their company name, Earnin. And they do provide monthly statements to their consumers. I have that in my notes from asking them. So
okay.
It is a practice done. They obviously collect that data anyway. So I do think it is, just for the sake of the record, of bringing or refreshing everyone's minds, it is something they already provide to consumers. So I do think there's some merit in it. We can certainly move on, depending what else the committee is, but I think it is an important one to think about.
Yeah, I don't think it's meritless, and I think it's certainly worth considering. And DFR doesn't oppose reporting requirements.
Thanks.
Fair to say, but we didn't include them in this bill at this time. In part because, along with many other things, we want to see what the sort of evolving best practices are going to be, and be in line with those. And just to let you know, I mean, one of the reasons why this is powerful to have the same requirements in different states is, oftentimes that lets you coordinate closely with other states, because, a violation of your rules tends to be a violation of theirs. And then, if we have the same, violation as, violation of Vermont law is also a violation of California law, we can call up the regulators in California, where, they have orders of magnitude more customers and they're bigger things, and we can tag team these things, and it just increases our leverage exponentially. And also, if Vermont has a lot more leverage when they realize, okay, if we don't get in line or do what Vermont is asking, this is going to turn into, a 50 state action against us. And I don't know, we've seen a lot of value in other spheres of having, consistent laws and being able to collaborate with other state regulators. But again, there are lots of things that we go our own way on, and we always have that right.
Jared?
I think it would be good to hear from the perspective of the businesses that would be affected by this regulation, whether it's positive or negative.
Yep, and one of the things that I just add to that is, the several people on the line here, are appearing before legislators and regulatory bodies around the country. And honestly, they probably have a better idea of what's being discussed in other state houses than we do. We're not regularly listening into committee hearings in other states.
Anything else under this subject? Okay. The other pieces of the bill?
Yeah, I mean, there was one about why we increased to 4 draws instead of 3. Just in talking to people, it seemed like whether it was from attempts to collect from a direct deduction from an employer or to collect from an account, it seemed like the standard that most folks were using was this 4 attempts, and typically what that looks like is 3 attempts, and then if someone a year later wants to use the service again, because oftentimes what they'll say is, okay, if you don't pay this back, we can't bring an action against you, but we don't necessarily have to extend you another advance if you never paid back the last one. So most of them have sort of a concept of, they try 3 times, but then they want the ability, if someone comes back to them and says, I want to be a customer again, I'll pay back the old advance, that they can make that one last attempt at collection. And again, we didn't see too many complaints about the number of attempts. The complaints were about attempts not happening on the dates that they were authorized, and causing overdrafts, which again we tried to address here by having an affirmative requirement that they only do it on the days they're supposed to, that they use reasonable efforts to avoid overdrafts, and that if they cause any overdrafts by not doing this on the day they're supposed to, that they're on the hook for reimbursing the consumer for those. So that was that issue. We previously had something where we were allowing ACH as one of the only permissible ways of trying to draw on a consumer's account. It's on that same theme of unintended consequences. Folks were saying, well, oftentimes we'll do the first attempt by ACH, but then for subsequent attempts, we'll use debit rails because those don't incur overdraft fees. And there's this new Fedwire system that's in development and probably going to be coming out in a few years, and that was likely to replace ACH or augment it. And we're just realizing there are all these other ways of doing electronic transfers that we weren't necessarily intending to prohibit, and that weren't problematic to us. So what we did is we again, tried to put some constraints on it, reserve the right to come in and place limitations through rulemaking if we learned of anything that was a problem, but to not create something that was so narrow and inflexible that it was going to, outlaw a bunch of current practices that we weren't intending to outlaw when we made the change.
Ethan, a quick question on the 4 attempts piece. Is there a applicable or comparable other financial transaction under current Vermont law where that 4 attempt thing exists now?
It's pretty unique, right? Because ordinarily, if someone doesn't, pay you a debt, you can send it to a debt collector, or you can sue them to collect the debt. You're not necessarily limited or constrained in the legal rights that you can, basically any rights you have under the contract, you're allowed to exercise, sort of subject to our debt collection rules. So we did, make it clear that Vermont debt collection rules apply to any earned wage access provider. But again, I'm not aware of anything right now that's quite comparable in terms of this. Yeah, I don't know if Aaron is, but I see him sort of suggesting he's not aware of anything either.
Yeah, I'm not aware of any other limitations like that.
So just to clarify, when you were saying the 4 attempts piece is, is standard, I was sort of just trying to capture your words about that. So could you just say again then what that's based on then in terms of 4? Because we had a lower number before, so I just want to make sure.
Yeah, before we had 3,
Mm-hmm.
and I think there was an ask that that they wanted an additional time if they had a consumer who, after the fact wanted to, they sort of wanted the ability to have a final time when they could take that consumer back. I said, because the typical practice is that they, if they're unsuccessful in collecting in advance, that they're not going to make advances to that particular consumer anymore. They're not going to sue the consumer. They can't send it to a debt collection agency, but they don't have to advance that consumer more money if they didn't pay it back the last time. So there was just this desire where if the consumer wanted to come back and authorize them to make that 4th attempt, that they would want the ability to do that. We had allowed 4 attempts under the payroll deduction. One of the reasons for it is they were, sort of explaining reasons why, they might need apparently a variety of different things that could disrupt a payroll draw from going through. And I don't have my notes on that readily at hand and don't remember all of the things, but or being a litany of different things that we had not considered when we had put more narrow constraints on that, and thought that it seemed reasonable as it was explained to us. Again, if you'd rather go back to 3, you're certainly within your rights to do it. My impression is that if you did 4, it doesn't require anyone to change their practices. And I'm not sure that there's a hugely meaningful difference to consumers between 3 and 4. So if you disagree, you're certainly free to disagree.
Sure, and even just to super short-handed, so this 4 idea came from the industries, from the companies.
It came from industry.
Yep, thanks.
Okay. Anything else that you want to weigh in on, Ethan?
The one other thing is I'd say that the change we made to the private right of action. What we did is we reduced the private right of action to just deal with unlicensed activity. say everyone we talked to was concerned about the private right of action. And I think we would be an outlier in having a private right of action among other states. And for the most part, we don't have private rights of actions against other providers, with the exception being, for unlicensed activity of lenders, we have a private right of action. So we thought, we have very broad and aggressive enforcement authority, where we can police our licensees. But if you do engage in unlicensed activity in this state, all bets are off. You have to answer to us, and you have to answer to the consumers too. If they want to sue you directly, if you want to do business here, get a license. And no one liked that either. But no one could make a good argument to me for why we should be going easy on unlicensed providers.
Even I'm not sure where to look this up or if this is a thing. So when they obtain a license, does DFR make a distinction between companies that provide loans versus credit versus are there subcategories of essentially lenders, or I'm just curious?
No, there are. We regulate. We have a broad lending license. There are different rules for mortgage lenders than there are for commercial loans. There are some exemptions from licensing that apply to commercial loans that don't apply to loans to individuals. And our usury laws are different too, depending on whether it's commercial or dealing with individual transactions. There are certain types of financing transactions where there are some additional requirements, under Title IX. So, different products can be, regulated differently. I would say most of a lot of our licensees are just broadly licensed lenders, but there are different rules for different products. I think it's safe to say.
Is this a broadly licensed lender? Does this fall under that big bucket of broadly just general licensed lender?
So right now, these entities would be their own license type.
Okay.
So they wouldn't have a lender license, and this wouldn't authorize them to engage in loans. And sort of the alternative is and we haven't conceded that it's not the case, is that we could seek to regulate these this product under the licensed lender statute. That's something that we certainly considered. That would have a pretty profound chilling effect on the industry, and we were somewhat reluctant to kick it out of the state essentially during the pandemic. So we think there are elements of it that would be a square peg in a round hole. So dealing with it with its own body of law and as its own license type, we do agree with. I think it's probably the best way to do it.
Thanks.
Jonathan?
Ethan, my parents were lawyers and they always taught me that anybody can sue anybody. So I'm just curious why we're enumerating the private right of action for damages or not enumerating it, as the case may be. Don't individuals have that right in any case?
Yeah, they have the right to sue for breach of contract. They have the right to sue for for tort violations. But not everyone has the right to sue. If some provider doesn't comply with its annual reporting obligations to DFR, like ordinary consumer can't sue that, doesn't have a private right of action to sue that provider because they failed to comply with some element of the regulatory, in part because they don't have direct damages. other things, if you don't necessarily have a private right of action against someone just because they've done something without a license. Sometimes you do, but it varies, depending on the regulatory body.
So if those requirements were enumerated in the end user agreement, then they would have a right to action regardless of what is explicit here, because they would be in breach of contract if they failed.
Yes, this isn't constraining any rights that the consumer, otherwise has under our Consumer Protection Act or under contract law or under tort law or any other theory of law that they have. This is just saying expressly, if someone does business with them as a unlicensed entity, they can bring a private right of action against them.
Thank you.
Okay, anything else?
So there wasn't anything else that I wanted to call out about our changes specifically, but of course, if there's anything else you'd like to ask us about, we are here and happy to come back anytime.
Any other questions, committee, for DFR? Okay, thank you very much.
Thank you.
Thank you.
Thank you.
So I think, cursor to work here. So I think I'm going to go to Ben first. It was Ernin that brought this to us, and I think most of the conversation's been around earned in and the gratuity. So Ben, welcome. Good to see you again.
Hey, thank you, Chairman. Thanks, everybody. First, I just want to say thank you to everybody in the committee and Ethan and Aaron at DFR for being very thoughtful and putting together what I think is a really well-crafted and well-balanced piece of legislation that you guys have before you. I know that it's late, so I'm just going to pause there and say I think that this legislation is, again, well-crafted, well-balanced, and be available for any questions if you want me to maybe give you guys updates on any of the stats or anything, or any questions on anything of the gratuity specific stuff that would be helpful.
Questions for Ben on the gratuity part? Questions on Emma? Edie? Sorry, I was looking.
Hi, Ben. I think it's the same question. I think it's the same question that I asked you when you were here before, and I'm just curious, how difficult is it for you to report to consumers the percentage of money that they are paying you for services for the money that they get?
Yeah, it's a little hard to do it in app because there's, the screen is small and there's not a lot of space there. Also, I think just one concern in general, and Ethan sort of outlined this, is anything specific that we did for Vermont only is going to be hard for us to do. I think that the idea of some sort of regular notice or comment, monthly or annual to a consumer, that might be a good place for it. Hey, this is how much of your wages you've accessed. This is the amount of fees or gratuities or other things you paid. This is, the percentage of that. You could do that in an email in a way that would not be, rivalrous of the screen.
Okay. And just to say, if you did it in Vermont, you could do it for everyone. Just nothing stopping you from doing that.
Yeah.
Thank you very much.
Well, to build off of that, hi, Ben, I was just wondering, so if California still hasn't done its rulemaking, are you required in any state right now to do anything in any particular way? Because we're sort of at the beginning of all of this. So I'm also just trying to wrap my head around what are you consistently required to do anyway right now between states?
So no states are regulating EWA specifically as EWA, but we are subject to Deceptive Practices Acts or other financial transactions. So like I think we talked about it last time, a Federal Reserve, it's called Reg E. It dictates all, like if you're to debit somebody's bank account. So there's a whole set of regulations that say, if you debit somebody's bank account, then you need to abide by, this giant federal regulation. So we're subject to all of the other existing financial services regulations, which is broad, but just not specific to EWA.
Yeah, thanks.
Other questions for Ben?
Ben, if an artificial cap were to be put on the interest rate regarding your business model, would that affect your decision whether or not your business would want to continue to do business in the state?
It's a great question. I think one thing that when we're thinking about tips, I think one thing to keep in mind is that because of the voluntary nature and the fact that people don't tip sometimes and tip other times, it's hard to just put a hard cap on it. We do cap tips at $14 total per transaction. But we ask people, why do you tip? Why do you not tip? People will say, well, it was a tough week this week, so I didn't tip at all, but I like the service. I want to support it. And so I gave a big tip next time. So even though they might have given a $10 tip on one transaction, they might have given a $0 tip for 5 transactions. And so therefore their average tip was only, $1.60 over the course of their 6 transactions.
If I may, just to clarify, so you just said that your company has a voluntarily self-imposed $14 limit on tips.
Correct.
Okay, thank you.
But a clarifying question, you only loan up to $100.
Yeah, we provide $100 per day in available wages.
And the tip is 100% voluntary, correct?
Any other questions for Ben? Okay.
Thank you.
Thank you, Ben.
Thank you so much.
I'd like to ask Ryan Naples to come speak next. Ryan, are you there?
I think this is Jane Levine, and I don't know if you can hear me.
Yes.
So Ryan is my colleague.
Okay.
At Pay, and I think I'm going to be taking the laboring order today, if that's okay.
Okay, that's fine. Go ahead, Jane.
Great. Well, thank you. I want to ditto all the thanks given to Ethan and Aaron at DFR and David Hall and all of you for spending so much time on this bill. It's really a lot of work has been put into it. And I think I speak for all of us. We really appreciate the attention. I have a number of things I wanted to point out about the text of the draft that we just received that we've been going over. But I wanted to say that almost all of the daily pay comments are not really about changing the substance as much as they're about kind of correcting some technical mistakes that, as Ethan was talking about, might lead to unintended consequences, particularly for our business model. And I'm happy to go through them, which I will do that quickly, but I also think it might actually be more efficient and probably less torturous for everyone if at the end, and David Hall, I offer this to you, where I send you, specific proposed language rather than, reading it off here. So if that's okay.
Yes, you can send that directly to Chair. Mike
David and the chair, to all of you. Rather than sitting here and, dictating. But just, a couple of the examples.
Share screen.
Do you want to share your screen so we can see what you're addressing, or?
No, well, I don't. I having just received it, a few hours before. I don't have a markup to share with you, but I can kind of point out to give you a flavor for the kinds of things so you would understand. One nit is we had asked to include specifically independent contractors in the definition to not leave it vague. I know they've been talked about here. We would propose adding that in. We had offered language to do that. There's, another place in the definitions where a provider is defined as a person in the business of offering EWA services to consumers, we would propose, and employers, because the employer integrated models do deliver services to employers. So that's kind of the nature of the change. It doesn't really change the substance, but would clarify. One global point that we noticed, and I think relevant to a lot of the discussion here, I believe that we proposed incorporating the licensing requirements that Vermont has under Chapter 72, which I believe give the commissioner very broad rulemaking discretion already. And I know, it is specified here again in many places. And I just wonder if that's necessary, or if that may actually be interpreted as somewhat limiting to say that there's rulemaking for this subject, but not others. So we had proposed just a global incorporating Chapter 72 and then making it quite clear. So we're not suggesting that there shouldn't be rulemaking authority, but just, wondering the best way to establish that. I have a question about this section 2302B, where again, I think it's just a very, I'm not sure what the intent is, but it seems to imply that any person, which would be like any entity or company, including a financial institution, but not limited to, who's providing substantial assistance, which is a broad term, to a provider, who got notice without being specified what kind of notice, to a provider, would have to stop doing business with that provider. And I guess I would just suggest that language be tightened up, because I think that could be applied so broadly that you could theoretically be telling a vendor who, you can't do business with a provider. And I'm just not sure that's the intent. I'm not exactly sure what is the intent of that provision, but I would ask you to take a closer look at it.
Where is that again, Jane?
It's in 2302, under the, license required section B. It may be that you want to intend to limit a bank, to not deal with someone that hasn't received an official notice of something, but the way it reads is extremely broad. I just wanted to point that out. I have some other things, but I'm not going to take you through all the little nit things. I'll send that later, but one thing that was more important to us is section 2305. And it's kind of reiterating a point that we made before. And the 2305 has to do with the, it's entitled now non-recourse obligations and permissible collection. And I appreciate that there were changes made that I think tried to accommodate some of the comments Daily Pay had, but it's still structured in a way that is telling licensees how we can operate our business, as opposed to setting the standards for if you use a particular method. If, for example, if you are using a payroll deduction, then the following standards should apply. As opposed to saying, here is the list of ways you can do this. And I think that that's a really important structural change to make sure that we're not stifling other business models. And having the law provide the standards as opposed to dictating, the commercial terms that are applicable. And we did suggest some language to change that. Just to move on, something that I see that was in DFR's draft, but then got taken out, was some language, and this has to do with, it's in 2306 in the prohibited acts section, where the intent of the provision, which we have no quarrel with at all, is to, a provider can't, take a security interest in a consumer's property, like collateralize a car or a house. Nothing that anyone in the industry does, as far as I know. But the way this is worded, actually, it doesn't fit with some of the business models that we know exist, where there might actually be a security interest from the employer in the wages. And we had proposed language that we believe accomplishes just what you want to do, which is prevent consumers' property, like in the payday loan context, being collateralized, but then allows the industry, especially in the employer integrated side, function the way we need to function. So I'd like to send that language and ask you to reconsider our language on that. Another nit, there's a reference throughout to charges and fees, and sometimes it just says fees. And we would prefer that it not say charges and fees and just say fees, but whatever it is, it needs to be consistent so that there's not an implication that you're referring to some other thing besides a fee or a charge. And I guess two more areas that I just wanted to flag, going to 2307, and that's entitled The Applicability of Other State Laws. And, this is where, we had submitted other language, and I think it's, important that if Vermont's creating a separate licensing path with all the bells and whistles, it's under Chapter 72, which is the same licensing regime that applies right now to banking and other licensee applications, that it's clear that no other licenses for this services that we're providing, okay, not limited to what is being dealt with in this law, that no other licenses are needed. And we had language that we think makes that clearer and more just clarifies it. And on the wage assignment piece, we're actually interested in having it not. It's not that we don't want it to say that it's not a wage assignment, but rather that it's not out of compliance with existing wage assignment law. And that's important to some of the business models and the way they function. And I think gets to the same place. So I, again, would ask you to consider the language that we had submitted. And the last thing before I bore you all to tears, but I think this is important too, is in the end where where the Vermont existing privacy law applicable to financial institutions is incorporated by reference, and there's an amendment to cover that, which we're in favor of. I think you also need to have a parallel amendment to the definition of customer to include consumer, which is the word used in this statute, to make sure that those protections to consumers under the EWA bill you're looking at are incorporated. And we have proposed, we threw in some language, and I can send that over as well. So like I said, very technical. I have a few other nits which I'm not going to go over. I'm happy to send them over, but some of these, just to reiterate, are not just me playing around and choosing words that I like, but they will have an impact on whether or not Daily Pay in particular can do its business in Vermont. And that's why I raised them, not just to, trade language with all the lawyers around. So just wanted to reiterate that. Okay, I'll pause and see if anyone has any questions for me.
Thank you, Jane. Any questions, Jane? The pieces that you bring up to us, they were discussed with DFR and during the last 2 or 3 weeks that we haven't looked at this bill?
So yes and no. Most of them, DFR, we spent a long time going over, and many of the requests that we made, I see are incorporated, so thank you. There were a lot of drafts coming, and I will apologize. The lag time between my ability to get to them and digest, I think I'm like a draft behind. So that's part of the issue. And I have now taken a look at the draft that we received today, and that my comments are now directed to the current draft. So.
But it's obvious that we're not going to be able to pass this tonight, but I'm going to give you about a day to touch base with DFR, and if they agree to some of the pieces that you're talking about, we can make those changes, but we're out of time. We need to have this out by Friday, so.
Okay.
No, work with DFR if there's other changes that they're.
I don't know if I speak for Ethan, but it's very fun to talk to him about this. So I will see if I can get a meeting and go over some of these things, and we can come to agreement. That I will undertake that. Thank you.
Thank you. Molly, do you have anything more to weigh in on outside of what Jane has just gone over?
Hi there. Thank you. Molly Jones from PayActive. We're one of the employer integrated providers. I don't have much to add. I did want to express real thanks to everyone who has put so much effort and thought into this draft legislation. I think it's really strong and has really important consumer protections included in the bill, and we're glad to support it.
Good. Any questions for Molly? Thank you, Molly. Alan.
Hi, my name is Alon. I'm a director of state and local public policy for the Northeast for the Chamber of Progress, which is we're a tech industry coalition committed to ensuring all Americans benefit from technological leaps. Our corporate partners do include Earnin and Chime, but our partners don't have a vote or a veto over positions. We actually came with some testimony to let you guys know that we support the bill, and we had come with some suggested amendments. But both of the amendments we were going to suggest, it sounds like, have already been incorporated. So thank you to you guys for all your hard work. So I just wanted to close by throwing out a statistic that we found that was really interesting about EWA services and explains why we support this bill. We were looking at a recent survey of consumers that showed that EWA is actually mostly used to pay bills on time, buy groceries, and avoid late fees. And 8% of EWA users say their life has significantly improved after using these services. But just want to thank you guys for all your hard work, and thank you for your time, and we support this bill. Thank you so much.
Any questions? Great, thank you very much. Jeff. Jeff on? Is Lauren on?
Yes.
Lauren?
I apologize. Thank you. I am Lauren Saunders. I'm the Associate Director of the National Consumer Law Center, which works for economic justice for low income and vulnerable consumers. I'm testifying tonight in the place of my colleague Jeff Walsh, who lives in Vermont, is unfortunately impacted by the storm and does not have power. We, have also submitted written comments, which were joined by Vermont Legal Aid. And Vermont Legal Aid shares our concerns that Vermont should not eviscerate its strong anti-predatory lending laws and interest rate limits by creating a loophole for a new kind of fintech payday loan. Vermont currently does not allow payday loans, which plague consumers in other states. And let me be clear, this law would change that. And both fintech payday lenders and traditional payday lenders would take advantage. The bill would exempt fintech payday loans from lending laws, taking Vermont on a very different path than California is on. Both employer-based earned wage advances and direct-to-consumer tip-based advances are forms of payday loans. Advances on pay, ahead of when pay is due, repaid later. The tip-based advances don't even deserve to be called earned wage, as they have no connection to wages, payroll, or employers. They're just payday loans repaid by debiting bank accounts like other payday loans. They rely on purportedly voluntary tips, but these are not tips to a human being like at a restaurant for good service after the service. They are payment for a loan promised before the loan, and clearly, the cost of that loan. They can trigger overdraft and NSF fees each time they are debited, potentially, 3 or 4 times. Earnin has long promised to reimburse overdraft and NSF fees, but people are still complaining about getting them reimbursed, even after Earnin has paid millions to settle class action a couple of years ago. These loans are not unregulated. The law is just not being enforced. Vermont law is clear that, quote, the payment in money as consideration for any sale or assignment of wages, whether earned or to be earned, shall be deemed a loan. Vermont law is also clear that there is no voluntary exception to its usury laws. The Vermont Supreme Court long ago rejected attempts to defend against usury claims by asserting that the borrower voluntarily paid. And in an 1827 case, the Vermont Supreme Court recognized that individuals in financial distress find themselves in the power of others. And therefore, when usurious charges are paid, it is not accurate, quote, to say that the act of paying the money is wholly without constraint. And an 1863 Vermont Supreme Court case found that there were, quote, numerous cases in the books for the recovery of usury paid, in all of which the payments had been voluntary. Now, we've heard references to California. California has not come out with their final treatment of these products, but they have issued an advisory opinion about one very unique business model, different from the ones we've been talking about tonight. Read carefully, and you don't need a magnifying glass, that opinion signals where California is going, treating all of these products, other than the one unique one where the employer itself pays the wages, treating them as loans subject to existing interest rate and fee limits. This bill would take Vermont on a completely different path, creating a large loophole in your lending laws, as I said, which would be exploited. Earned wage advances and tip-based payday loans have similar problems of rollovers as traditional payday loans, with multiplying fees that look small, but drain wages and result in workers paying to be paid. Studies have shown that workers use employer-based advances nearly every pay period. And a General Accounting Office report released just last week shows that users of a direct-to-consumer lender, which is almost certainly Earnin, borrowed 26 to 33 times a year. Now, a $100 advance on the Earnin app for 11 days adds an $11 default tip. Plus, it costs another $3.99 to get the money instantly. Earnin discloses a 0% APR, but in total, that's the equivalent of 498% APR. And clearly payday level pricing, $15 for a $100 advance. Several earned wage advance companies have told me that 90% of people pay expedite fees, which isn't surprising because if you want your pay early, you want it early. People don't realize how these payments add up to high APRs or high dollar amounts over time. And of course, payday lenders too can trot out surveys of how their borrowers love their services, but we know how they push people into chronic reborrowing and a debt trap. Companies also have multiple ways of pushing people into tipping that just simply can't be legislated, from using default tips that are cumbersome to undo, dark patterns, or as in the fine print of earn-ins agreement, cutting off overdraft alerts if you don't pay it, if you don't tip enough. A consumer who took out 30 loans a year at $15 each would pay $450. And that GAO report released last week said that 78% of the users of that tip-based lender make under $25,000 a year. They can't afford to lose that money. Some employers, like Walmart, using its earned wage subsidiary Even, offer early pay for free. That is a growing option. If this is a benefit, employers can pay for it. But there's no reason why Vermont should authorize costly fee-based models and treat them different from other payday loans. These concerns are why nearly 100 consumer, civil rights, and labor groups have urged the Consumer Financial Protection Bureau to make clear that these products are loans and should be treated the same as other loans. And the CFPB said last month, in the GAO report last week, there's a letter dated last month that said the CFPB intends to clarify its treatment under federal law. We also expect California to clarify its approach soon and to release the extensive data that has been collecting on the costs of these advances for the last couple of years. And I urge Vermont to wait for that data from a neutral source rather than rely on tidbits in this process before you rush in to eviscerate your strong consumer protection laws. We see no problem in Vermont law that needs to be solved, but certainly not imminently, and big problems if this law is enacted. Thank you.
Questions? Emma?
Where did you go on there? Sorry, Lauren. So your camera's not on, so we can't see you. So I always cheat.
Yeah, it won't let me turn it on. I'm trying, but
don't worry about that. My brain's tired at the end of the day, so I always like to take a look of the person's name so I can get their name right. Lauren, can you repeat the tip or the piece that you mentioned around use a statistic around the use of direct-to-consumer products? The lender borrowed something like 36 times a year. That particular piece, because I'm just curious around the equivalent of the APR piece that you mentioned.
Sure, those come from two different sources. So just last week, there's a report, on these products. It basically said, there's potential promise, but there's lots of risks. And it collected data from some employer-based products and from a direct-to-consumer lender. It didn't say who that was, but to my knowledge, Earnin is the only company out there that collects tips in a direct-to-consumer model that calls itself Earned Wages. And it said that lender, that people borrowed on average 26 to 33 times a year. The APR that I quoted is our calculation based on an actual example of somebody who used the Earnin app for a $100 advance for 11 days. It put in a default tip of $11. From their expedite fee schedule, it's clear that if you want that money instantly, you'd have to add $3.99. So, just simple math, the APR equivalent, turns out to be 4.98%.
Thank you.
Hi, Lauren. So if this is already legal in Vermont, I'm curious how having a law around it is detrimental.
I think it's illegal in Vermont. I think the law just hasn't been enforced. And as a state without payday loans, I would urge you to exercise extreme caution before you open up your very strong laws to allow a new form of payday loan.
Thank you.
Lauren, I was just curious, has the kind of the information letters and things that you submitted, so I know like the EWA companies and lobbyists and stuff have been talking to DFR. Have you or other advocates against kind of this feature also had conversations with DFR?
No. To my knowledge, they haven't reached out to us. Now, again, I'm not in Vermont, but I know they haven't spoken to my colleague, Jeff Walsh, either.
Thank you.
Question? Jared?
So I have questions in regards to referring to a tipping model as an APR. I feel like listing it as an APR insinuates that it's not a voluntary system. As we heard from our Assistant General Counsel, Ethan McLaughlin, before, and he was referring to the model that roughly 40% of consumers flat out declined even putting a tip out there. And of the remaining 60%, between 85 and 95% of them actually reduced the amount of money that they're putting there. So I'm just trying to follow this where we're trying to compare a tipping model to a adjusted rate percentage, which is obviously with the loan practice, but if they're not collecting money off a service that people can voluntarily choose to get that money earlier for an additional service, because it is a service-based product. Someone wants to wait longer for a free product, they can. But if somebody decides they want that money sooner, then they pay for that service. And if somebody decides they want to put a tip in, then they're voluntarily choosing to put that percentage of a tip in. So I'm just trying to understand why it's being conflated with an APR when it's not a loan. I mean, it is a loan, but they're not charging an APR on it.
Well, an APR can be calculated based on the actual payments that the person makes. I've seen a screenshot from the EarnIn app with an 11% tip in there, putting in the figure 0% APR. Now, maybe if you really, the people, if they didn't pay anything at all, obviously that would be a 0% APR. But putting that in along with a 0% APR, frankly, I think is deceptive. But at any rate, it's the actual cost that people pay. And with respect to these, there's also these turbo fees or lightning fees or whatever you call them, which are far higher than the actual cost of delivering money instantly. If they're using RTP, it costs 4.5 cents. But fees go up to $4 on EarnIn. And I would add that there are other providers who aren't here, but they also charge expedite fees up to $10. So again, Vermont doesn't have any exceptions to its usury laws for whether things are voluntary or not. And you can calculate an APR based on what is actually paid.
Well, and that's where I find the difficulty in the correlation here, because if someone is charging a loan and they mandate that a higher than market average percentage gets paid back on that loan, and the consumer does not have a choice on that, then I can definitely see usury there. But there's a situation here where the consumer has the voluntary option of saying, I'm not going to pay a tip and I'm not going to go for this additional service. Because, I mean, for example, like people can watch YouTube, but they'll get a commercial and they have to sit through it. Or if people don't want to watch a commercial, then they pay for that additional service. And that's where I'm kind of failing to see the correlation here, because the consumer has that option in this business model. Those 15 transactions you referred to, the consumer in those 15 transactions, if they choose not to add any more voluntarily chosen items to that business model, they can in theory have this service done for completely free, which personally I think is a great advantage of people that may not necessarily have the time to, the ability to get that additional payment earlier, but at the same time, they still have this option to work with. And that's where I'm failing to see the correlation here. And especially with the amount of time that this bill has been out here, I mean, this is the first time I've heard this particular type of complaint referenced towards this law. So, and
well, as I mentioned, there's 96 groups that signed a letter to the CFPB. So the concerns are widespread. There are lots of ways that people can be, pushed into tipping, make it difficult not to tip. I mean, do some people manage not to tip? Certainly, or maybe they don't tip on every advance and they tip on some. Earn-In originally cut back how much you could borrow if you didn't tip enough. They got caught doing that when that was, publicized. They changed their business model. You cannot set the default tip to 0. You've got to undo it every time. Again, they have something called, I can't remember what it's called, but they alert you if you're about to overdraft and then if you want to borrow. But if you don't tip enough, then they turn off those alerts and then you've got to go back in and manually turn it on. There's dark patterns. There's, all sorts of ways. And at the end of the day, the cost is what the cost is. And this bill has no cap on fees. And, obviously they're getting enough money to sustain a large company. And it's things that we don't even think really get much liquidity. I mean, there was some reference to what people use these loans for. That's the exact same things people use payday loans for, but really they're filling the hole in the paycheck from the last advance because their paycheck has a hole in it, not really getting new liquidity.
Anything else for Lauren? Lauren, thank you very much.
Thank you.
Thank you.
Monica?
Good afternoon, everyone. Can everyone hear me okay?
Yes.
Thank you so much. I know I'm the last person to speak, so I appreciate your continued energy toward this issue, and I'll try to keep it brief. My name is Monica Burks. I'm Policy Counsel for the Center for Responsible Lending. I'm also a single mother. I've also spent most of my adult life making a low wage, and I'm also thankful to talk to you about this issue today because of those reasons. CRL is a nonprofit, nonpartisan policy and research organization. We are dedicated to building family wealth through the elimination of predatory lending practices. Because of that mission, we've been monitoring EWA products for years. We're following the activity around the country as this very bill makes its way through multiple state legislatures, and we know what's happening everywhere where it's been introduced. It sounds like DFR has worked with industry over multiple drafts of this bill. Consumer groups were not invited to that process. We would love to engage with DFR and explain some of our concerns, and some of those I'm going to summarize for you today. Given the opportunity, for example, if we had that opportunity to join that conversation, we would have expressed that allowing 3 or 4 attempts to debit a bank account, each attempt that could cost up to $35 is going to harm consumers. This is especially true in this context where at EWA advance, the average is around $100. I want to personally, having watched these hearings since H87 was introduced, thank you all for the consideration with which you approached this bill. And it reminds me that in 2012, this same legislator had the wisdom to protect citizens from high-cost payday loans. The APRs on these EWA products are as high or higher, as you just heard from Lauren, as payday loans. Vermont has already determined that with that high cost on this product, it's not valuable for your consumers. That's why payday lenders do not operate in your state. What this EWA bill does and why it's actually more harmful than not regulating it right now is it creates a massive loophole around existing consumer protections by carving out products from the definition of credit. Saying that EWA advances is not credit is what we call a legal fiction. If we put it simply, when a person advances money to another person who in turn agrees to repay that money in the future, that's a loan. This is exactly the nature of the product that direct-to-consumer EWA providers offer. EWA products are loans with the same potential to trap borrowers in a cycle of unaffordable debt that ends up worsening their financial situation. That is why consumer groups are concerned about tips. That is why we are concerned about expedite fees. Because regardless of the title that you put on it, it's breaking down into finance costs for these low-wage workers. Now, we also want to join NCLC and Vermont Legal Aid in recommending that this committee decline to vote on this bill. And instead, we admonish you to check into the CFPB's guidance. I know Lauren mentioned that the GAO requested that the CFPB put out clarity around whether or not EWA products are considered credit, the CFPB responded and said that they will be sending that guidance out. That's going to be important because if we pass this bill in this current regulatory environment, Vermont will be the first state to make a very big declaration that these loans are in fact not loans, and that's going to have huge implications all over. We also want to note that the payday lenders in their prior testimony, they advertise their loans as things that consumers access for emergency funds. But as you just heard from Lauren, these products are used repeatedly. EWA providers should be treated as creditors so that the expedite fees and the tips can be included in APR disclosures that are required by the Truth in Lending Act. And the thing that is so important about APR is it allows borrowers to compare the true cost among credit options. So treating these providers as creditors would ensure that a person can decide whether it's the best financial move for them to use an EWA loan versus other options. And we understand, as Earnin has already disclosed to you, that they are actually targeting people who live paycheck to paycheck, people who don't have, I believe it was something along the lines of they're credit thin, or they don't have access to these nice credit cards. So they know that they're targeting people with limited options for money that is much needed. And because of that, because they are going after such a sensitive demographic, it's really important that these consumer protections that apply to creditors also apply to EWA loans. It's the same thing with the expedite fees, right? They say it's optional, but when you need money in a rush, choosing something that takes 1 to 2 business days versus something that you can get within 30 minutes, that's waiting for the free option almost negates the entire reason for asking for those funds. So it's inducing users to pay that fee to access money that they need. So once again, when you have this type of power imbalance, it's very important that existing consumer protections in the state apply to these users. You also heard Earnin testify that 40% of their revenue comes from tips, and that they would have to significantly change their business model if they were asked to even change the default to 0 for the tip option. This is actually strong evidence that their business model depends on loans for which the true cost is often going to be higher than advertised or disclosed. Regulators in over a dozen states have announced a multi-state joint investigation into EWA companies like Earnin that use the tip model. New York State, which is leading that investigation, described the investigation as centered on the fact that some of these firms appear to collect usurious or otherwise unlawful interest rates in the guise of tips, monthly membership, and exorbitant additional fees, and they may force improper overdraft charges on vulnerable low-income consumers. So this product, having been around for 10 years, is already raising serious concerns in multiple states amongst multiple regulatory bodies. We don't have any hard and fast rulemaking to make it clear that these are creditors. And so it is so vital that you not pass this bill in its current form, because it would create a statutory right for them to distribute this product outside of the consumer protection that you all have already set up. So just to summarize, we asked this committee to reconsider whether the timing and the origins of this bill are appropriate. We urge you to consider forthcoming rulemaking from our federal bodies and from other states, and we would love to communicate with DFR on this bill. Finally, if and when you decide to vote on a bill to regulate this activity, we feel that it is imperative that the bill regulates EWA providers as creditors, including acknowledgement of tips and expedite fees as finance charges, and limiting those finance charges to the existing state interest rate caps for small loans. And I'm happy to take any questions.
Questions for Monica? Eric?
Hi, Monica. First of all, I just want to thank you for your perspective on it. One thing that I have had a concern regarding this bill since the beginning of its introduction is, once again, precedent to enforcement. And as you mentioned before, in terms of how it's going to be handled among other states, So I would actually say that I agree with you in the fact that it probably should be shelved until our counterparts in the federal government can do more to actually explore it. Because right now, even though there's things in this bill I do agree with, I don't think Vermont should be the state to lead forward in terms of putting it out there. So I'm happy to hear your perspective on it. And I'm definitely interested in hearing perspectives from other states as well, because that's one of my concerns I've had since the beginning, is especially when there's any law that's technically the first on the nation, which I know California had its regulatory aspects, but I'm not comfortable with Vermont being the first the first law passed forward in the nation regarding this law. So I would definitely appreciate hearing your perspective on it, especially, as I mentioned before, the perspective from other states as well. So that way, if this does move forward, then maybe it can be introduced at the federal level, and then they can go through and have everybody's sides heard more accurately and have all the information. Because right now I feel like regarding both sides of the issue, whether it's the for or against, I don't think we have enough information to comfortably put this into a legally binding document that is going to be enforceable by the rule of law. So thank you for your help on that.
No, absolutely. Thank you for your time.
Any other questions?
Very briefly, Monica, does your opinion align with Lauren Sanders on those employer-based payment forwarding models, or is there just no distinction there in your mind?
I think where NCLC and CRL align is that treating these products as loans and making sure that consumer protections apply to them is the most vital part of this process, because without it, consumers don't get the information and they don't get any protections around how much they are being charged to access funds.
Thank you.
Hi, Monica. I really appreciate your testimony. So thank you for hanging in there with us, for being the final witness of today. I really am quite interested in these investigations that you mentioned, New York. Could you mention the others? I think you said there are 3 states. I don't know if you named them, but I'm just curious if you can name those for the record for here.
So I don't have, it's actually 9 states.
Oh, no.
I'm sorry, almost 12 states. What I can do is follow up with the actual report. It's publicly available, so you can have insight into that rather than misstating the folks involved.
No, that would even be better. Yeah, that would be great to know where this is actually being investigated. I appreciate that. Yeah.
Other questions? Monica, thank you for joining us this afternoon. We appreciate it.
Yeah, thank you all.
Thank you.
Just for the record, we had invited Vermont Legal Aid to come in and testify. They declined. I know they were referenced twice that they're joining, but we asked them to come in and testify, and they declined to come in. So I just want that on the record.
You don't have a consumer protection. You're not big enough to have a consumer protection piece. That may be part of it, Mr. Chair.
Well, I know, but they're referencing that they're working with them and they agree with them, but they haven't come in. We invited them to testify and they didn't provide any. I just want, everyone to know that. So.
But they did sign the letter that was submitted.
That's good, but.
Yeah, I'm just saying.
We invited them to come in.
They did have an opportunity to come in.
We offered that opportunity and they didn't feel they needed to. So, I mean, we've heard a lot of testimony this afternoon. We've heard a lot of testimony a couple weeks ago. I'm not interested in putting any more time into this bill if I don't have committee support on the bill. So I need to know, do we go forward or are we done with this for now? Heather?
I'm done with it. I can't, I mean, the last 2 witnesses articulated so well what's been just upsetting me since we first heard about it. So I just want to be really honest up front. I don't think I can vote for it in the form it is in now, or if we tweak it a bit. Thank you, though.
I have to agree with Heather. I'm not going to vote for it either. And I realize we have our disagreements on certain aspects of it. In terms of the legal capacity for the state of Vermont, the sheer size of this particular industry, and especially given the testimony that there may be issues with it in other states, I don't think now's the time to move forward with it, especially given the amount of time that we have left in this session. I think anything that we would put out would be rushed and would legally be a headache for the state to deal with later on. So I would just say we just either shelve it or can it.
That's 2. There's still 9 remaining.
I really appreciate hearing from the last 2 witnesses as well. I've had a lot of hesitation about this, learning about, I mean, I had no idea what earned wage services were before January. So I really appreciate learning. But I have to now learning even more today around California, where they are in the process, these investigations, what the GAO was asking for. There's a lot of pending information that I think would really better inform us about the best path forward. And while there might be some elements in here that modified would be better, it's making a lot more sense to me that these are indeed loans. And I want to make sure we're consistent with what California and other entities that have a lot more resources and have done a lot more investigation into this are doing. I know that leaves us not regulating this market at the moment, but I think the pro and con weighing this out, we need to get this right. And I'm not inclined to support this at this moment.
Yeah, I think we, if we were in any possible way going to move forward with it, we definitely need to do a lot more research. I think we, to what Emma said was that we've learned that there's a lot more information out there, a lot more things to consider, and we don't have the time or energy at this point. I think it's prudent to put it on the back burner and see what some of these other findings come out.
I think, go ahead, Jim.
From the beginning, I had misgivings about the sort of business that it, and I think it was confirmed over time that these fees that they charge are predatory. I think that's part of what the last 2 witnesses confirmed today. So I'd like to see something done about this, but I think we ought to shelve it for now.
I'm curious from the what was said today about comparing it to payday loans, because when you had told us that basically it was regulated to not allow those, and this felt so much like payday loans that I hate to wait on this. I mean, like you said, because it's leaving it deregulated, but so I'm super I feel like we need to do this, and I don't want to see it just dropped. But I'd err on the side of let's do that level of regulation for now and then scale back if we need to or something. But yeah.
I think so. I don't agree with everyone's assessment. I think that, in my mind, people make a choice, and we can't be there to hold everybody's hand. But I think we probably need to wait to hear what California is doing and what else is coming out before we make a decision. So, I mean, I'm fine with pinning it on the wall and letting it sit there for until we get more information. I would suggest to DFR that they continue to look at this industry and keep us up to date of what's going on in that industry. And I'm sure they're keeping an eye on what's going on in Vermont. I think maybe we've been insulated somewhat because I've never heard of this before. And I don't really think DFR did, it came to their attention last year or the year before. So it seemed like it's overly prevalent. There's not been any complaints in Vermont that we know of, that we're aware of. So I think they can keep an eye on it.
Mr. Chair, I think there's a very clear distinction in my mind regarding the employer-based models. Mm-hmm. And I don't think it's possible or likely that we can extract any of that or salvage any of that from this bill. But I was familiar with that model going in, and there seems to be, at least from the testimony we just heard from Lauren and others, a clear distinction as to its predatory or in the case of the employer-based models, non-predatory nature. So I don't know if anything, if at all, we probably don't have the time, can be salvaged of this regarding that specific piece.
Not with the other work that we have.
Sure.
Yeah, I mean, it seems like it is, they are acting in the state because it is too.
Yeah.
So it's not like by not acting, we're removing this from the state. It's just that it's gonna go forward the way it is without as much oversight.
So if we leave it on the wall, we can pull it for next year.
Oh, yeah.
Yep, so we still have time to do something this biennium.
We can pull it after crossover, it's just,
Yeah.
we can't, anything we send over to the Senate won't get taken up
If
after
we get,
crossover.
if we
Because I feel
we
like
get
we're making
information
good
in the
progress.
next month or so that gives us better information what California's doing and, I mean, I think the last 2 or 3 testifiers were, talking about the doing something. I'd like to know what lawsuits are out there or what investigations are going on in other states. They have information that we don't have. Maybe that's something that DFR could dig into a little bit, better understand what might be happening, and maybe those, the people that brought that discussed the testimony could send that to us or send it to DFR so that can have a better look at what's going on, if there is anything going on.
Yeah, I'd like to have DFR work with these consumer advocate groups to get that their side of and their opinion and the research that they've done as well.
I do wonder if we could salvage any, even if we drop it into workforce bill or something else, just any kind of reporting. If we can get some reporting back, it sounds like at least Earnin is providing a lot of data to their consumers. And so I wonder if they can kind of compile that, aggregate that and send that to DFR or to us, just so that we can get a better understanding of how much is being accessed in the state and how much is
only getting
fees that are paid. Yeah,
Yeah, I'm looking for California for the data. I feel like we're gonna get really good data from them and it's gonna be more recent. And I'm concerned that some of the things that were cited in the last 2 testimonies weren't as recent because I feel like laws have changed and tightened up. But I really liked that the state interest rate caps for small loans is something that I felt like that was something that I could grab onto that would make me feel like we're protecting people in the state and, or some kind of statewide piece that was, so I feel like we're getting there, but I'm very happy to let it sit until we have more information.
I would ask committee members to do is touch base with our education committee and ask them to pass the financial literacy bill that we put in. That's what really needs to happen is we need to have people understand. Okay, anything else? Okay, back on the workforce economic development bill in the morning after the floor, H10. Another wonderful discussion. So, any questions?